If you spend any time looking at commercial real estate deals that are broadly marketed for sale, you probably noticed that brokers are really quick to use the term value add in their marketing materials, and this is for a very good reason. The term value add itself infers that there's upside opportunity for the buyer in both operating income and the investor's ultimate sale value, which can often push pricing way above what the property would have traded hands for without that upside in place. But after underwriting thousands of these deals myself throughout my career, I've seen very clearly that just because a deal is marketed as having value add potential doesn't necessarily make it a good investment. And in this video, I want to share 4 things that investors need to consider when analyzing these types of deals and why these investments aren't always everything they're cracked up to be. So the first thing that investors need to consider when underwriting value add deals is the level of construction related risk they're taking on to create that value. Investors looking for value add returns are by default expecting higher returns than core or core plus investors, but to generate those higher returns, they also usually need to make physical changes to the property itself through capital improvements. And even though capital improvements can make a property nicer or run more efficiently, these also tend to come with a lot of risks to the economics of a deal itself, with cost overruns and major construction delays being very common occurrences within commercial real estate. And even if construction projects do come in on time and under budget, there's typically no guarantee that tenants are going to be able or willing to pay more than what they're currently paying, regardless of how nice those renovations are. And if capital improvements wrap up at a time when new supply in the market is high and rents and occupancy levels in the market are low, this can cause huge misses in projected returns to investors on a deal. The key takeaway here is that even though a value add deal requiring a major renovation might look good on paper, investors need to make sure they feel really confident in both the costs and the time frame required to implement that business plan, and also what the strength of the leasing market is going to be at the time those renovations are ultimately complete. Now, the second thing I want to bring up in this video is that not all deals that are branded as value add actually have value left to create. A buyer that believes they can increase the NOI and value of a property will almost always be willing to pay more than another buyer that doesn't see that same upside, which often leads brokers to use this term when marketing deals that don't actually fit into this category. If a property was built in the last 5 years, if the seller renovated most or all of the property already, or if the demographics of the area just can't support higher rents in the first place, these are all cases where the term value add usually wouldn't be applicable, and underwriting major rent growth or expense reductions when valuing these properties is usually going to lead an investor to make unrealistic return projections. A great example of this would be a multifamily property that was built in the last 10 years in a low-income area in the outskirts of a major market where the majority of the tenants are renters by necessity. And while brokers might say there's an opportunity to push rents due to economic growth in a nearby metro or a lack of new supply being delivered in the submarket specifically, if the median income in the area is $50,000 and you need to take rents at the property from $1,500 a month to $1,800 a month just to make the deal pencil, this probably won't turn out well, even if this looks good on paper. In reality, a renter that's already maxed out and spending 36% of their pre-tax income on rent probably isn't going to be willing to bump that up to 43% for the privilege of having stainless steel appliances or cooking on quartz countertops. And even if a renovation would make the property significantly nicer overall, the demand for that product just wouldn't be there at that price point. The key takeaway here is to always do your own research to make sure the value creation opportunity you're being presented with is actually feasible in practice, and to make sure your assumptions related to that value creation are all backed up by data. Now, the third thing I want to mention here is that because value add investors usually expect higher returns, the financing in these deals is often very aggressive. When deals are profitable and cash flow is strong, debt can be a great way for investors to add fuel to the fire, but if things don't go as planned and cash flow is tight, debt can significantly increase default risk. Value add deals are often financed with loans that include a short-term interest-only period where the borrower is able to free up cash flow for the first 2 to 3 years of the loan term by only paying the interest portion of each loan payment. But on value add deals, by definition, you're banking on being able to increase rents and the income a property can generate. And if an interest only period burns off before you can make those things happen, this can lead to major reductions in investor distributions and in some cases, even capital calls. A lot of value add business plans are also very reliant on short-term hold periods where the property is quickly sold within a 3 to 4 year time frame. And because fixed rate debt often comes with hefty prepayment penalties, floating rate debt is also very commonly used. And just like we've seen over the last 3 years, this can create serious issues for borrowers when interest rates rise unexpectedly, and this can also lead to higher cap rates in the market, which can make it harder to refinance or ultimately sell an asset. This is a main reason why a lot of value-add investors will look at both levered and unlevered returns on a deal to evaluate performance both with and without debt. And while aggressive financing structures can make a deal look great on paper, cranking up your LTV just for the sake of doing that isn't always the smartest move when it comes to managing risk. Now, the last point I want to make in this video is that because there are so many moving pieces within a value-add business plan, returns on these deals can be very heavily influenced by factors completely out of your control. Value-add business plans generally take anywhere from about 1 to 3 years to implement, which means that while an investor is renovating or releasing a property, they're almost always going to be subject to changes in market conditions. And this means that even if the leasing market is strong at the time a property is acquired, if renovations won't be finished for another 3 years after that acquisition is made and a huge influx of new supply enters the market at that time, the rent premiums you may have underwritten initially as a result of those renovations might not end up materializing in the way you would have hoped. A lot of multifamily developers are dealing with this problem today, with projects that broke ground in 2021 or early 2022 entering their lease up now at a time when rental rates are either at or below where they already were at the time construction started, which has led to issues with investor cash flows, property refinances, and even in some cases, developers selling their deals for less than what they paid to build the property in the first place. Changes to things like interest rates, consumer spending, income demographics, and even capital markets activity can all have a huge impact on rents and values in a market over time. And even though there's a lot an investor can do to renovate a property and improve operations, the time it takes to make these things happen almost always comes with added risk. So whether you're an analyst trying to make better recommendations to your manager, or you're an entrepreneur looking to find profitable investment opportunities, I hope these things are helpful. And if you want to learn more about the real estate investment analysis process itself, or you want to make sure you have the technical skills you'll need to pass an Excel modeling exam that might be given to you when interviewing for analyst or associate roles at commercial real estate firms, make sure to check out our all-in-one membership training platform, Breaking a CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Breaking a CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more content on different commercial real estate investment strategies, make sure to hit the like button and let me know. And let me know in the comments if you'd want to see another video like this on core, core plus, or opportunistic deals in the future. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week. And I'll see you in the next video.